Well, Asian markets, they have opened up mixed today, following a surge that we saw on Wall Street in the overnight session. The Nikkei was down close to around 0.2%, so that's trading mildly in the red. In fact, it's holding with a cut of around a tenth of a percent approximately. The dollar yen, the yen has strengthened against the dollar, and that's come down below the 111 odd mark. Strength on the yen is not good news for an export-oriented economy, so keep an eye out on the yen as well. That's the one that normally moves the market out there. But the Kospi has opened up with the green. That's sitting with a gain of around 0.2%. The Taiwanese index as well had opened up with a gain of around 0.3%. Now that market's holding with a gain of around 0.5%, while the Straits is well up, close to around 0.4%. Safe to say that the Asian markets, they've opened up more in the green than the red, and the SGX Nifty, for starters, is indicating maybe a 5 to 10 point bump up, but maybe in fact, going by what we can see on the Asian markets, maybe we can brace ourselves for a little bit more green on the screen.
All right, that was about the Asian markets, but the big news coming in overnight was the US Federal Reserve on Wednesday deciding to hold rates steady and also signaling no rate hikes for the rest of the year. CNBC's Steve Lisman joins us with more details.
The Federal Reserve, in a series of major announcements after its March meeting, kept interest rates on hold, downgraded its economic outlook, and forecast no rate hikes in 2019. The meeting of members of the committee had previously forecast 2 hikes this year. They're gone now. The Fed also decided to stop reducing its balance sheet, which some in the market had said was hurting the economy, and that would begin in September. For a central bank that moves policy slowly, it was a rapid about-face for forecasts of strong growth and a rate hike as recently as December. Despite the changes, Fed Chairman Jerome Powell maintained a positive outlook.
The data are not currently sending a signal that we need to move in one direction for another. Committee members, participants generally see growth of around 2%. They see unemployment remaining below 4%. They see inflation remaining close to target, and they see growth, as I said, around 2%. So, that's a positive outlook. It's a favorable outlook.
Still, the Fed downgraded its outlook for growth from 2.3% to 2.1% this year, and Powell highlighted risks to the economy coming in part from global developments.
You see slowing global growth. You still haven't, there's no resolution of Brexit. There's no resolution really of the trade talks. These are ongoing risks. We're also carefully monitoring what's happening with U.S. growth. We called that out in our statement. You know, the limited data that we have do show a slowdown. On the other hand, as I mentioned, we see the underlying economic fundamentals for growth this year as still very positive.
Finally, Powell noted that downward pressure on inflation is a major challenge for the Federal Reserve and central banks around the world. But overall, no hint from the Fed chairman about what the next move is, up or down. And Powell gave the clear impression today he doesn't know either. Steve Lisman, CNBC Business News, Washington.
Okay, right. Then on that note, let's get in some more opinion from experts on what they make of the Federal Reserve's decision.
It's hard to earn your net interest margins if you have such a flat yield curve, and at the same time, they are doing better. They're better structured. They're more liquid. They have better capital bases, and if you think that's bad here, look at the European banks. I mean, it's even worse in terms of what's happened to that index over time. It's had a little pop back up, but it's been hammered over the last year. So these low interest rates, in their case negative interest rates, do enormous damage to the potential for the banking system. And I think that's pretty clear in the way the market's reacted.
I was really looking for the Fed to be very dovish and really spin everything that they did in Q4 of last year back the other way. Whether they came to 1 or 0, I don't think the market would have really had a huge impact. At the margin, this is better, but I mean, the ending of QT was well advertised. The fact that they're tapering immediately and it's done by the fall is probably somewhat better news. But this was going to be a dovish Fed no matter how you sliced it, and I think the market's reacting to it accordingly. What we got today was a really clear Jay Powell, and that's the biggest message, is that we've got a chair that seems to be better at communicating with the market and not making any of those errors that he made in Q4.
Flattish yield curve is meant to be an augury of something not good. And suddenly the market is baking in expectations of a Fed rate cut. I think there's 50% chance of that by the end of the year. So, the Fed is meant to be patient. It contends it is patient, but there seems to be a certain jumpiness about its patience. The Fed has changed course in the face of a change in inflation as they measure it, And see, in December, it was 1.9. And today that number is 1.8. And that is supposed to be the source, I listened to the previous panel, of the chairman's malaise or uneasiness. I mean, that's scarcely measurable.
Well, Fed sees no hike in 2019, but let's move on to the US markets. Wall Street rallies as shares of Apple and Micron surge to lead the tech sector higher. The strong upside momentum comes a day after the Federal Reserve signaled that it was unlikely to raise interest rates this year amid worries over slowing economic growth. The Dow Jones closed 216 points higher, the S&P 500 closed over 1% higher, while the Nasdaq Composite outperformed, rising 1.4% at close. CNBC's Eric Shemi gets the wrap of all the action on Wall Street.
U.S. stocks finishing in positive territory. The Dow up 216 points, the S&P gaining 30, and the Nasdaq rising 109. Mortgage rates sinking to the lowest level in more than a year after the Federal Reserve left interest rates unchanged yesterday and signaled it would not hike again this year. This could mean some relief just in time for struggling homebuyers for the spring selling season. Americans had faced mortgage rates north of 5% at the end of last year. Biogen losing nearly $20 billion in market value today. The biotech giant and its Japanese drug partner announcing that they are ending a later stage trial of what was seen as a promising experimental treatment for Alzheimer's disease, as the results were not as positive as anticipated. Biogen is the latest in a string of pharmaceutical companies to halt research on Alzheimer's. Eli Lilly, Pfizer, AstraZeneca, and Merck have all canceled trials in recent years. And blue jean giant Levi Strauss is back on Wall Street. Shares began trading on the New York Stock Exchange near $22 per share at the market open. That's beating expectations, and it gives Levi's a market value of almost $9 billion. It's the second time the 166-year-old company has gone public after its first debut in 1971. Levi's stock finishing nearly 32% higher on its first day of trading. That's the action from the U.S. market. Back to you in Mumbai.
Okay, that's about the U.S. market. Shifting focus, though, to the European markets, they ended on a mixed note as the U.S. Central Bank decided to halt interest rate hikes for 2019. Now, in the U.K. also, Bank of England held interest rates steady, and the U.K. market, in fact, was the only outperformer yesterday. That ended with a gain of around 0.8%, while both the other two big boys, as the screen is telling you, ended in the red.
All right, that was about the European markets, but the European Union has agreed to postpone the United Kingdom's exit from the bloc, but the length of the delay will depend on whether or not the British Parliament accepts the previously negotiated withdrawal agreement. An unconditional extension has been given until April 12th to indicate a way forward. If PM Theresa May's deal is passed, Brussels will give the government until May 22nd to pass the legislation that would implement Brexit. However, if a deal is not agreed by April 12th, then UK will be left with two choices according to EU: a no-deal Brexit or agreeing to hold the European election in return for a long A50 extension.
All right, then turning our attention to the currency space, the dollar index, which tracks the greenback against a basket of currencies, bears gains on the back of the Fed Reserve's decision to hold interest rates steady. Meanwhile, the Japanese yen as well strengthened versus the US dollar. That, in fact, has come down below the 111 odd mark, currently holding at around 110.7 mark.
Shifting focus to the world of commodities then, crude oil hold firm, hovering near a 4-month high. Prices are supported by a sharp tightening of global stocks, OPEC production cuts and US sanctions on Iran and Venezuela.
Okay, time to slip into a short break. You come back, we'll get you all the cues and news that are stacked up for us when we open up a trade in the next couple of hours.